We've been talking about growth through acquisition. Now, if there's an acquisition opportunity that appears to have good potential for value creation and growth, then it makes sense to do an acquisition analysis. Now, fundamentally, an acquisition analysis is essentially a cost-benefit analysis. And both of those pieces are important. First of all, is there a benefit? Is there a good reason to take on all the risk to attempt this acquisition? But then second of all, does that benefit potentially outweigh the costs, right? I mean, there's lots of things that can go wrong in a merger or an acquisition. So we have to be really careful about thinking through what the cost and what the benefits are. Now, the costs don't just involve the purchase price. I mean, essentially it eventually all gets rolled up into the purchase price. But as you're thinking about the potential offer price, purchase price for that target, you have to think about all of the costs that you might need to incur to make that acquisition really work. So that includes costs of integration down the road. All of these things that might potentially cost you something are things that you ought to bake in to the acquisition price and discount accordingly, right? And in doing so, you shouldn't just think of your best case scenario. You should also think of your worst case scenario. What's going to happen if we don't realize the synergies we thought we were going to realize? Or what happens if all of the talent in the acquired firm leaves right after the acquisition? So you have to think through what could go wrong here and how might that increase the costs. And again, the benefits have to exceed those costs. So one useful way to think about this is we could think of it like an equation. So the first element of this equation is the idea of the strategic benefit. What is the strategic benefit of this potential acquisition? And we might think of strategic benefits like efficiency gains or complementarity gains. So efficiency gains have to do with things like, if we can improve our cost structure, if we can eliminate redundant functions in our overhead. Those are things that might lead to some efficiencies. Complementarity gains are things like, will this acquisition add to our portfolio of products in a way that's complementary to the products or services that we already have? So we might think of things like, Disney acquiring Pixar. So they acquired a sort of set of capabilities. Pixar had a way of making animated movies that was a little different than Disney's traditional way of making those animated movies. So when they acquired Pixar, they acquired those capabilities in a way that was complementary to Disney's existing products and capabilities, right? We also might think of an example like Pepsi. Pepsi acquired Gatorade and Tropicana and Quaker. So Pepsi had a soft drink and a snack division, and it turns out Pepsi was really good at managing its distribution channels and getting those soft drinks, those bottles and cans, and getting the bags of chips onto the shelves at the retailers. So it turns out that if we acquire some additional product lines, Gatorade or orange juice, we're already good at getting products like that to market. And so we're able to sort of offer those complementary products in a way that's beneficial to us. So those are some examples of strategic benefits that might arise. Other examples of strategic benefits might be, we might conduct acquisitions as a way to try to consolidate the market. Now, of course, these kinds of horizontal acquisitions where you're acquiring essentially a competitor, these are the types of things that are frowned upon and might be prohibited by regulations and by governments. And the reason for that is, it's very beneficial to the businesses to be able to roll up an industry like that, right? But that might be a potential benefit if there's a way to sort of accomplish that's ethical and it's legal and that sort of thing. It also might be an attempt to diversify risk. So an example might be Cemex. They're a Mexican-based cement company. And they've done a lot of expansion through acquisition, but they haven't really changed fundamentally what they do. They make and deliver cement. But they've expanded all over the world into different geographic markets. So, we might think of that as they've scaled up their operations, but they've done it through acquisition. One of the things that's accomplished for Cemex is it's allowed them to hedge their risk a little bit. So, it turns out the market for cement really fluctuates based on, the housing market, right? That's one of the primary uses for cement is in real estate, either residential or commercial. So So by expanding through acquisition all around the world, CEMEX is able to sort of hedge their risk a little bit. If the market for real estate goes downhill in South America, maybe it's going up in Europe or vice versa. And if they have businesses in all of those different geographic markets, then they're able to sort of hedge against sort of market downturns and upturns or currency risk or things like that. So this is a start towards thinking about how we might consider an acquisition analysis to be sort of an equation. And this first piece of the equation is the strategic benefit.